and welcome to EconVersations. I'm your host, Dr. Dan Sutter with the Johnson Center for Political Economy at Troy University. Many people, when they learn I'm an economist, will ask me for some stock picks. I can assure you I'm the last person you're going to want to ask for investing advice. But stock markets play an important function in our economy, and that we can talk about. An analysis of the determinants of stock prices can shed light on why it is that it can be so hard to try to pick stocks that will end up soaring in value. Joining me on EconVersations today to discuss the role that stock markets play in our economy and what we know about this, how the prices of stocks emerge in markets is my colleague from the Johnson Center, Dr. Thomas Hogan. Thomas, welcome back to the show. Well, to get started, why don't you tell us a little bit about what is it that people actually come to own when they buy some stock in a company?
Yeah, so I imagine a lot of your viewers have a general idea about the stock market already, but it's probably a good idea to start with some of the basics just to set the framework for what we're talking about. So when we talk about a share of stock of a corporation, the person that owns a share of stock is actually a part owner of that corporation. Mm-hmm. And I think probably most people are aware of that, but if a big corporation has millions of shares, then if you own one share, then you only own a very small portion of that company. But it is an ownership share, and so as the owner of that company, you get some percentage of future profits from that company. Mm-hmm. When the company does well, they make really high profits and they pay a lot of that out to the stockholders. And if they don't do as well, then they only pay very small amounts out. Mm-hmm. And it's possible that the company could go out of business completely, in which case, as the owner, when the company goes out of business, if there's any assets left of the company, they would sell those off and give the stockholders some small amount back. But basically, people buy a share of stock because they think the company's going to do well. They expect it to have profits in the future, and they're hoping to capture some share of that profit for themselves.
Now, not all businesses have stock like this, right? I mean, some businesses are organized in different fashions. Like if you or I were to start a business, we wouldn't start by issuing stock, right?
Yeah, so not all businesses have publicly traded stock, mm-hmm. right? So we say that stock, another name for stock is equity. It's an equity investment, and all firms have equity, even small firms that are not publicly traded. Right. So for example, someone that owns a small firm, it might have one single owner, or it might have two partners that split it 50-50 and each own equal shares of the equity. Or even a small firm might have many different owners, but still be privately held, where not everyone is allowed to buy and sell that company, mm-hmm. but only a small group. Publicly traded stock is different, where when a company becomes big, they can issue stock to the public that can be bought and sold by everyone. Mm-hmm. And so there are some differences in terms of the regulatory burden that's required in order to sell your stock publicly. You have to be certified under a lot of different regulations by the SEC and other groups like that, so that people that are buying and selling your stock on a secondary market, that weren't the original owners of that stock, that they know that you meet some kind of minimal requirement set by the SEC, right? And so in some sense, owning a share of a very large corporation mm-hmm. is just like owning a share of some private corporation, but there's a question of whether the stock can be bought and sold by anyone. Mm. So when you have big corporations, all the major companies that we think of, Exxon and McDonald's and Microsoft and Google and all these giant companies, they have millions of owners that know very little about the company, other than they're an owner of the stock because they think that company is going to make money in the future. Mm-hmm. And so that's the same reason a small privately held company, people invest in that too because they want to make money, but they can't buy and sell their stock to anyone the way you could for a major corporation.
So the corporate form of ownership has turned out to be very important in the development of our modern global economy. Why was it that corporations and this corporate form of ownership, this ability to sell stock, has turned out to be so important in helping businesses grow so large?
Yeah, so to give some background, I don't want to get into too much detail, but looking back in history, we can see that the corporation, and especially the joint stock companies, mm-hmm. evolved a few hundred years ago. We can think of some of the firms starting around 1600. We see some major firms in Europe, like the British East India Company and the Dutch East India Company, were two major corporations that were established for the purpose of trading with India and China and other Eastern countries. And those companies were established as joint stock corporations where they could openly sell their stock to anyone that wanted to buy it, basically, and anyone that wanted to buy in became a part owner of the company. And so even hundreds of years ago, we had some of these companies getting established, and I think we kind of talk about the Amsterdam Exchange as being the first real stock exchange where the Dutch East India Company wanted to be able to sell their stock to anyone that wanted to buy it. And so they started a stock market where people could come in and anyone that wanted to, that had enough money, could buy some of their shares. And so there's a little bit of debate about whether that was actually the first stock market or not. You know, there are lots of stock-ish things around Europe. But certainly in the 1600s, both in England and in Amsterdam, they started stock exchanges where large companies would begin selling their ownership, their stock, to anyone that could afford to buy it. And so that's evolved a lot over the years. You know, we now have major exchanges in the United States. The New York Stock Exchange is probably the most well-known, and these exchanges started the same way, where they were companies that came together and wanted to sell their stock. And so lots and lots of people would come, and it would be a big market where some people were buying the stock and other people were selling the stock. And so people have probably seen a lot of the pictures or are familiar with the older stock exchanges that were what we call open outcry markets, where people just come and they're all yelling and screaming and trying. You see the guys waving their arms, and that's mostly gone away.
Right.
I mean, that's still allowed at the New York Stock Exchange today, but most trading is done electronically, and you know, it's easy to see why. Electronic exchanges make it very easy to exchange money. I mean, the New York Stock Exchange, it's still, even though it's computerized, it's technically done as an auction market where you have some people that are buying, some people that are selling, and they're all just kind of mashed together into a market. You do still have a few people trading on the floor of the New York Stock Exchange, but not nearly as many as in the past because it's so much easier to do it electronically.
So if I was, interested in buying some shares in Microsoft or Coca-Cola, and went on a stock exchange, and bought some on a stock exchange, would I be buying them directly from Microsoft or Coca-Cola, or who would I be buying them from?
So those major exchanges, the stock exchanges, are what we call secondary markets, because the person who's selling you the stock is not the company itself, usually. Okay. I mean, in most cases, what we see in the secondary markets is that person that's selling you the stock bought it from someone else, that bought it from someone else, and so on. And so when companies want to go from a small company where they have a small group of private owners and their stock can't be bought and sold by everyone, they do what we call an IPO, an initial public offering, right? Initial means the first time, public offering means they're selling it to the public for the first time. So like I said before, they have to go through some regulation from the SEC and other entities in order to be able to sell their stock to the public. And then companies come out and sell it for the first time. And for big companies, it's usually a major event. You may remember, in the last few years, companies like Facebook and Google and a bunch of different tech firms have had major IPOs that have been big events in the news. And a lot of people have bought into those when they've become public. But that IPO, the initial public offering, is the first time that stock is sold out to the public where anyone can trade it on a stock exchange.
And that's when the capital, or the financial capital, flows into the firm, right? When they do the initial public offering, or when they offer additional stock beyond that, right? That's when they're getting the financial capital they might need to expand their operations, right?
Yeah, exactly. So typically an IPO happens when a firm needs to get a lot more money for investment. So it's typically a small firm that wants to greatly expand their operations so much that they don't want to go to a bank and borrow all that money. That it would just be too expensive to borrow it from a bank. And so what they want to do instead is they want to issue stock. And so the first time they're doing that, they usually have some kind of major expansion involved that will require millions and millions of dollars. And so it's a lot of small firms, or middle-sized firms probably, trying to get really big and expand. Right. And so they sell the stock to the public, and the public buys the stock from them, and they keep all that money to invest and use in their business so they can expand their business in the future.
So if, one thing that might occur to people is that if it's very important for our economy to get, to have stock, to get financial capital invested into these businesses that are already successful so they can grow and serve us even better, yet then these stock exchanges like the New York Stock Exchange is really sort of this secondary trading of the stock that's already out there. How is it that the secondary trading ends up being so important for our economy?
So there are a couple of reasons that having that stock market there is important. So the first one is that the firm who's issued stock already, that's already done an IPO, can go out and borrow more. And it's a lot easier for them once they've done that to continue to grow into the future. The first time they have an IPO, the value of the company is very uncertain.
Right.
And so it's hard to tell when a company is about to IPO, what is that firm really worth? No one knows, right? I mean, you have a couple people that have had access to their accounting statements, their balance sheet, their income statement, and those people are estimating the value of the firm on the day that it's IPO'd. But it's not really until after they've IPO'd and that stock gets publicly traded that lots of people are monitoring that firm, that lots of people are making different estimates of the value of the firm. So that's good for the firm itself, because if I've already IPO'd in the past and I want to raise some more money, it's easy to issue more stock because people know what the value of my stock is, right? It's not such a big barrier as the first time we're going to do an IPO. Issuing more stock after that, it's easy. It's easy to raise funds. The second reason that that's important is because that price of the stock gives information to people in the economy. So the stock, the price of the stock is determined by the supply of the stock and the demand of stock, just like anything, any market economy. Any market we look at, there are some people supplying a good and some people demanding a good, right? And the price of the good reflects how many people want to buy it and how many people want to sell it. So the same thing is true in the stock market. We have some people that want to buy the stock, we have some people that want to sell the stock, and the price of the stock tells us what those people really think of it. What do they think the real value of the stock is? Because if more people want to buy, the value of the stock will go up. If more people want to sell, that is, they think the firm's going to do badly, the price of the stock will go down, right? And so the value of the stock, the market value that we see when we look at a stock exchange, tells us how many people think this stock's going to do better and how many people think it's going to do worse.
And just knowing that you would be able to sell a stock is in itself valuable to an investor, right? So that once you've taken a part ownership stake in a company, when you buy some stock, the knowledge that you'd be able to turn around and sell that stock relatively easily is itself valuable to an investor, right?
Yes, absolutely. As we talked about before, you mentioned at the start that the joint stock corporations have been a huge advantage for the United States and any developed country, because it's easy to invest in those companies. If I had to take all my money and invest it only in one company, that would be difficult because I would be tied only to the success of that company. And instead, I can invest in small amounts in all kinds of different companies by buying their stock. And so that's a big advantage to me. It's also an advantage to the company because they can raise lots of funds. Instead of just having one single owner, they can issue lots and lots of stock, have lots of owners, and become a much bigger company, take advantage of economies of scale, geographic diversity, where they can grow all over the nation or all over the world, that a small company owned by a single person or a small group of people would just not be able to do. So that's a big advantage for the entire economy and for people that live in the United States, where we have access to a stock exchange, because we can invest in these companies. That's better for us. They can grow and expand, and that's better for them.
And that might be a hard thing for us to see here in the United States, because we've had a well-established stock market for a pretty long time relative to other nations. But economists, when they look internationally, you can see some differences across countries about whether they have a well-established or a very liquid stock market, and that seems to be pretty tightly controlled to or related to development, right?
Yes, there's a very strong relationship between financial institutions and economic development. Countries that have well-functioning financial systems have much higher rates of growth in the types of firms and overall in general of the economy. So GDP, gross domestic product, is like our measure of how much stuff is produced in the entire economy. And so we look at countries and we look at how fast is their GDP growing? How fast is that economy expanding? And so we see that countries that have high levels of GDP growth, that means there are their economy's growing a lot, that the companies are doing well, and that people in that country are becoming a lot better off. And looking around the world at countries that have well-developed financial institutions, we see that they have very high rates of GDP growth, and countries that don't have well-developed financial institutions have low rates of GDP growth. And so we have this chart here that shows us that countries with very liquid financial markets like the United States,
so
that's the bottom bar,
stock
right? Well-functioning stock exchange, and even beyond that, banking system and things in general. Countries that have very liquid stock exchanges have very high rates of GDP growth, whereas countries that have very poorly functioning financial systems have very low levels of GDP growth. And this is true not only for big companies, but for small companies too. You might be aware, and maybe some of our viewers aren't familiar with this, but the idea of micro-lending that's taken off in the last decade or so. Micro-lending is when firms or even organizations, a lot of our volunteer organizations or nonprofit organizations, make very small loans to individuals or very small businesses that are trying to develop. And so we see this going on right now in India, a little bit less in Africa, Pakistan, places like that. India, for example, if you look at people that are farmers and have a hard time just getting enough money to buy extra crops to plant or to be able to transport their stuff from their farm to a market to be able to sell it. They need money for that, right? And it's not easy in a country that doesn't have any banks that can lend to small people. And so we see these microloans, organizations going in, making loans of $50 or $100 that can allow someone to develop a business or buy tools, or someone that's a basket weaver can buy tools to make more baskets or something like that. That makes a big difference. That makes someone go from just an individual on their own to really being able to start a small business. And so micro-lending, the developer that won the Nobel Prize a few years ago, because people are hoping that will make a big difference. Right now, it's still hard to tell how big of a difference it's going to make, but that level of financial intermediation makes a big difference. And so once we get up to the level of a stock exchange, when you can go from being a medium-sized company to being a big company, that makes a huge difference. And that's really what drives GDP growth as enabled by stock exchanges in small countries.
So you talked a little bit about what ends up happening in setting these stock prices once the stock is out there, that people are deciding, in effect, sort of either placing bets or making guesses about whether they think a business is going to be profitable or not. And although there's a lot of financial data on like profits and so forth, that when you try to estimate how much you think a company's going to be worth in the future, the stock market has to end up being future oriented, not toward the past, right? And so there's still a lot of, in the way of what economists refer to as expectations that are highly relevant. And so that's a lot of what's getting hashed out on a stock market, right?
Yeah, that's absolutely true. So the price of the stock today depends on how people think the company's going to do in the future. If they think the company's going to do well, the price is going to go up. If they think the company's going to do badly, then the price is going to go down. But as you mentioned, there is a great disagreement about what people think of different companies. And so everyone's trying to guess about what's going to happen in the future, and many people have very different estimates about what they think will happen. And so you can think any stock that's on a major U.S. exchange, there are lots and lots of people watching that stock. Big investment banks in New York, they've got 100 people that are all watching some certain industry, that are all looking at the couple of stocks in that industry, trying to estimate what is the right value of that stock. What's going to happen with this company in the future? Are they going to do well? And not just well, but better than other people expect? Or are they going to do worse than other people expect? And so it's very difficult, because even with a lot of data and a lot of information about the company, no one knows what's going to happen in the future. And so people have different ideas about what they think will happen. That leads them to have different ideas about what the price of the stock should be today.
But one of the things that ends also end up being, I think, very nice about a stock price is that it takes all that different information and helps condense it down into a number which is amazingly understandable for folks, even if they don't know a lot about corporate finance, if they couldn't read a balance sheet of a firm or anything. I mean, it's sort of almost like a score in a football game or something like that. from the score what's happened there, and the stock price
You can
tells
tell.
sort of
There's
the
no
same thing.
question. Yeah, there's a
And-
defined price, and that sets some kind of expectation about what the price can be.
And it's sort of hard to get around or avoid or, cover up things that the stock price is showing
Right.
us,
The stock gives us information about the company, and not only some small amount of information, but the aggregate information
Yeah.
of what lots and lots of people are thinking, right? Like I said a second ago, big companies have hundreds of people watching major stocks. And so it's not just one person that stood up and said, here's what I think the price is. It's hundreds, maybe thousands of people that are all giving the best information they can to try to guess the price of that stock. And so when someone comes out with some information that they think is wrong, we can, that is a report or something, we can compare it to the stock price and see what we think.
And it's a lot more understandable for most of us than, like, say, the annual report or of a company.
It's something everyone
or,
can read. It's a
like
simple
the
number.
detailed analysis that each of these stock analysts or analysts watching an industry might give here. And here we have, like, I think, put together a graph of the price of Citigroup back during the financial crisis. And, I'm sure at the time, people working for Citigroup were probably saying, like, we're not in that bad a shape. Our investments are sounder than you think or whatever. But here's the stock price, and it's sort of giving you an answer.
Yeah, no, Citi is an excellent example of when the market was telling us something different than the experts. And so to give a little context about the period that we're looking at and why we've chosen this example of Citigroup, Citi is one of the companies that did not do well during the financial crisis. They're a major bank. They were heavily invested in a lot of risky assets prior to the financial crisis, and when the price of real estate in the United States started going down, all the big banks that own real estate loans, their values started to decline, and especially banks that had a lot of mortgage-backed securities, because those were even more highly levered. And so when the price of those went down, a lot of banks lost a lot of money, right? And so when all these banks were losing a bunch of money, what happened was the Federal Reserve and the Treasury ended up coming in and bailing out a lot of these big banks. And so one of the funny things is that the Fed did this sort of mixed message thing where they said, we're going to come in and bail out these banks, but they're all so healthy anyway, they don't really even need the bailout. We're just doing this to try to help them out and for safekeeping. And everyone said, but wait, that doesn't make any sense. Like, why are you giving them a bailout if they don't need it? And the Fed was saying, oh, they're safe, you can trust us. And people pointed to the stock price of Citigroup and said, what do you mean they're safe? They were $50 a year and a half ago. The stock price has fallen below $1, right? I mean, that's a pretty bad signal. Citibank was going to go bankrupt. I mean, there's really no question. They fell from $50 to below $1 before the Fed swooped in and saved them with a bailout. And the Fed was saying, oh no, they're fine, they're not bankrupt. I don't think there's really any question. That firm was going to go out of business. They got saved by the Fed. And so that's an excellent example of times when the Federal Reserve was saying, oh no, we've checked their books, they're great, everything's fine. And as you mentioned, the CEO of Citigroup, I'm sure, was saying, we're going to do great, we've turned it around, we've fixed everything. But the market was saying otherwise. All the people, the thousands of people that were looking at Citigroup, they were looking at their balance sheet and income statement, they were looking at, what do we think is going to happen in the future? Are they going to do better? Are they going to do worse? Everyone thought they were going to get worse, right? And so that firm should have gone out of business, but they got a bailout from the U.S. taxpayers thanks to the Federal Reserve and the U.S. Treasury.
But the stock price ends up like being the scoreboard, when you can just, like, point to the scoreboard, and if somebody's saying, like, oh, we played pretty well, you can just point to the scoreboard and say, well, the scoreboard shows you didn't.
Yeah, the stock price is an easy indicator that everyone can understand about how well the firm is doing.
So we have these stock prices that incorporate all this information in it, and if they are incorporating all this information, then what's going to drive a change in the stock price?
So we talked a minute ago about where the price comes from. It's set by the supply of of people willing to sell the stock and the demand for people wanting to buy the stock. And just like any other good, if we look at a market for some good, we think, okay, the price is set by the number of people that are supplying and demand it. If more people want that good, that's going to be an increase in demand that's going to push the price up. If fewer people want that good, it's going to be a decrease that's going to push the price down. And so for any good, we don't have to think about fundamentally what is driving this. And people that are outsiders, I mean, surely people that are insiders and know a lot about a company, they're thinking about fundamentally what's driving it. But as an outsider, we can look at the price as being a reflection of the amount of people that want a good and the amount of people that don't want it. How many people want to buy it and how many people want to sell it, right? So the price itself of anything gives us sort of an aggregate of all the people in the economy, how many people want it and how many people don't. So in the same way, a stock, the reason the price changes is if more people want it for some reason, the price is going to go up. If less people want it, the price is going to go down. And why would more people want it? If they suddenly think the company is going to do better than they thought before.
So if some news comes out that looks promising for a company.
A change in what people expect about the future is going to change the value of the stock today. If they think the profits are going to be higher in the future, the price of the stock goes up. If they think profits are going to be lower in the future, the price goes down. And so when there is some kind of new news or new announcement about the company, that's going to affect the stock price.
Big question people often have is, can stock analysts or can stock pickers actually beat the market on a consistent basis?
Right.
And what does the evidence show?
Yeah, so I'll tell you, I mean, that's absolutely my students in finance, they come in and the first thing they say is, how do I pick stocks? How do I buy stocks? And I tell them, you want to wait on that because it's not really easy. I mean, you got to think, if the price is based on new information, you can really only make money if you have information that other people have. And I tell my students, like, I'm happy, I want you to get involved about learning about stocks and so that you can someday be a professional maybe, but you can't expect when you're just a beginner to make any money on that because, Goldman Sachs and Merrill Lynch and the big investment banks have hundreds of people watching that stock. They're friends with the CEO, they know the auditors that audited the books, they know everything about that company. And so you can't really expect to have more information than they do. And even when new news comes out, when we see a new announcement, it'll usually change the stock price, but very quickly. When an announcement comes out, the stock price changes within 5, maybe 10 or 15 minutes at max. Within the first couple of minutes, all of the change in price has already been taken advantage of. So if you read something in the news, you see Kramer on TV and Mad Money telling you to buy, you really can't make any money off that unless you had the information ahead of time.
And this is actually tied to, I think, a pretty big important issue for us as economists in terms of how we do our research, how we think about markets and the economy. And in economics, we have a feeling, we have an old phrase we like to say, well, you're not going to find money just lying around on the sidewalk. And,
right.
And if it was easy to make money in the stock market, then it would be like there's just money lying there on the sidewalk, and you just pick it up. And so at some level, it can't be easy to make money in a market that's functioning well.
Yeah. So I mean, it's definitely, it's not impossible, but on average, most stock pickers don't beat the market. You should just buy a stock index like the S&P index or the Dow Jones Industrial Index. Nobody really beats those over the long term. In a single year, somebody might, but not very many, because like I said, it's so difficult. Another thing is that people that are trading very short term, if you do have some kind of access to short term information, or if you're a high speed trader, the people that have computer algorithms that analyze price changes, you can make money in that. I mean, in the very short run of a couple of minutes, stock prices are not very efficient. But within 10, 15 minutes, they've already moved to the new accurate price. And so it's very hard over the medium term to make any money on the stock market.
Well, that's good to know, because now I can feel good about saying I know something about the stock market, but being unable to pick any stock.
Yeah,
so.
Investing in an index fund, I mean, when we say make money, we mean beating the market. You should try to get the market return. It's very hard to do better than that.
Well, thank you very much, Thomas, for coming on the show. I enjoyed it. And thank you. Join us again next time for another EconVersations.